Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So recently I've been getting requests to check out one of the Dividend Kings out there, and that's exactly what we're going to do today. So I'm going to go over the financials, I'm going to go over the business model, what they do, and then at the end I will tell you exactly what I think of this company and what I would do if I don't own the company, so it'll be interesting to see. And of course, and I'll let you know exactly what my opinion is. Again, it's not financial advice, it's just my opinion. Just do a quick request: if you are basically interested in Sharia compliant investment, like in the stock market and so on, and you have been watching the videos, it will be really wonderful if you can join us at the Patreon account, where you get access to all the the Discord, where a lot of brothers and sisters are sharing very good practices. And then you've got all the buys and sells that I'm frequently making. You've got the family portfolios, you've got the dividend trackers, the calendars, watch list, the ETF trackers, as well as the Sharia compliant investing ebook. So you've got a lot of little things that you can actually hopefully benefit from if you are especially a new investor. If you're completely new and you're starting now, the Sharia compliant investing ebook is probably a good one to start with. I'm uploading another one today, InshaAllah, just to kind of give you my methodologies, a summary of what I look for, what I'm trying to do, and what to do and what not to do, InshaAllah. So yeah, there's a lot of little things that you can benefit from, InshaAllah, and it will cost you only 15p per day. Right, so let's get started. And by the way, if you have not liked the video already, please do so, because it genuinely helps the channel. The company we got talking about today is a Complete Cloud Corporation. This is one of the what I'd like to call foundational stock. The reason I say that is because it's in consumer staples. It's been around for a very long time. It has a predictable kind of business. Is one of those dividend paying companies. So it's foundational, because I think every single portfolio needs a company like this, for example. And the reason I said that is because it has a lower beta. So it's not basically one of those companies that fluctuates between 300%, 4%, 5% every single day. So it's very, very stable consumer staples stock. And as you can see, a year to date is actually 15% up. Now let's look at the S&P 500. A year to date for the S&P 500 is actually up about 15%. So it's really tracking the S&P 500, which is very, very interesting. For the last 6 months, it's up about 17%. And for the 1 month, it's almost up 5.5%. But only down about 1.5%, 1.3% for the last 5 days. So it's really interesting to see this company that sells nappies and so on. So these are the things that they sell: Haggies, for example, pull-ups and good nights and dry nights and so on. So that's some of the products that they sell for baby care, baby and child care. They've got family care as well, all the tissues that we all normally buy without even thinking about. Okay, and they also have the feminine side of things. They also have adult care. So they do have a lot of different types of products. So what I'm going to do now is just go over some of the financials, and then I'll tell you at the end exactly what I think of the business. Now, as you can see, is in consumer staples, is household product. In terms of the investment theme, for example, we're looking at the long-term dividend play. Okay, and right now, so if you are long-term dividend investor, then potentially this might be a good hold. So you buy this type of business, you leave them alone, they pay you that dividend. If you see a pullback, you add to it and you leave it alone. It's one of those companies. You're not expect more than you're expecting a 3 to 5% revenue growth every single year. If you're lucky, if sometimes it could be 2, that's when probably it will go down and you add to it. So it's very similar to companies like Procter & Gamble, although Procter & Gamble has a bit of a momentum in comparison to this one. So management are focused on cost reduction recently. So they're focusing on this strategy where they're trying to cut cost. But one of the things they're trying to do right now is the 25% of their sales are coming from e-commerce. So that's one of the ways they're trying to cut costs moving forward, which is quite good to see, because financials have not been great for this business in terms of profitability. So that's one of the things that they're trying to do. Now, stock prices right now is almost 140. That's probably one of the highest it's been. I think the highest it's been, it's about 42. So there you go, $42 per share. But yeah, so the highest has been closer to the highest so far, so it has not actually come down quite a bit, as you've seen already. is basically almost tracking the S&P 500. Current EPS is $5.45, a market cap of $47 billion right now, and it has a narrow economic mode. Like I said to you guys earlier, beta is very, very low. When this basically is below 1, that means the stock is not really that volatile. Okay. In terms of PE right now, we're looking at about 25 right now. Forward PE of about 19, and the last 5 years, the average PE has been about 20. And price to free cash flow right now, we're looking at almost 40. And in comparison to the sector, current PE is about 18. So forward PE is very similar to where the entire sector is. And as you can see, the S&P 500 is about 29 right now. This is where this company shines. And as you can see here, the dividend yield right now is 3.4%. And that gives you about $4.80 for every share of this company that you own. The payout ratio is 69%. Now, this needs to come down to at least below 60, because that's normally what we're looking for. Latest increase is 3.4%, so decent, and the 5-year average is about 3%. Now, they have increased this dividend for 51 years in a row. Although it might be just 3% or whatever, it has actually increased that for 51 years in a row. That includes situations where there's been wars, there's been recessions, there's all sorts of things, financial crisis. Throughout all of these situations, this company continued to increase that dividend, which is one of the reasons why I said is very stable business. They're profitable and they will actually pay that dividend. The dividend safety is 88%, which is probably one of the highest. And free cash flow right now, $2.6 billion of free cash flow. Free cash flow yield, we're looking about 5.6% right now. That's about 3%, which is normally what we're looking for. And free cash flow margin is about 13%, which is quite high for based on what we're looking for. Now, in terms of profitability, we're looking at profit margin of 9%, operating margins of 15%, and return on equity of 209%. Return on invested capital 31%. So all of them absolutely fine. Total return in the last 10 years only 5%, and revenue growth in the last 5 years we're looking at about 2%. EPS growth, we're looking at about 3%, and current ratio is below 1. Normally what we want to see is basically above 1, which means the current assets can cover the current liabilities. Now, with regards to growth estimates for the next year, we're looking at about 6%, which is really quite good for this company. And then every single year following the following 5 years, we're expecting at least 7%, which is really good. Current ratio price we've already seen. According to Morningstar, they are saying it's fairly valued right now. $143 per share is where they think. So it's slightly lower than basically higher than where we are now, which is quite nice. According to Wall Street valuation is actually almost 30% undervalued. They're expecting almost $200 per share. When it comes to tip rank, they're saying it's 147. That's about 5% upside from where we are. And when it comes to Seeking Alpha, it's basically 144. And as you can see here, both tip rank and actually Seeking Alpha are saying is a hold right now. Whereas in comparison to these guys here, of course, they're giving us the valuation side of things, but these guys, the analysts actually are coming together and saying, okay, for right now, it's a hold. And I completely agree with them. Okay, despite basically the fact that it seems a bit undervalued at the moment, I think I used to own this company a long time ago, and I think it's been trading between 120 and 140 for a very, very long time. And in fact, if we go in the last year and a bit, you will see, okay, if you just keep an eye on here, you can see the price. Okay, the highest it's been is 137, and right now it's 140. So it's been trading around 120, as you can see here, for entire last 6 months. If we look at the 1 year, at one point it was 132, and then it's basically gone up quite a bit, 136, and then it came back, went up and went up again, if I can talk. And the last 5 years is more or less exactly the same, apart from COVID time, where basically in 2020 August it was one of the most expensive stocks out there. It was 157 because everyone was cleaning at that point, right? So yeah, so I genuinely agree basically what the analysts are saying here, and right now is definitely a hold in my opinion. Now, in terms of Sharia compliance side of things, absolutely no issues whatsoever, and they are buying back their own shares, which is quite nice to see. So you're getting that what was the dividend? About 3%, and they're buying back their own shares. They have a good free cash flow here. The dividend basically the margins look good. Next couple of years they actually expect it to do really well. Based on these analysts, they're saying it's not actually overvalued at the moment, which is good news. Everyone is agreeing on that, but it is a hold because it's closer to the 52 weeks. Now, in terms of charting, let's have a look. Let's compare this with the S&P 500 in terms of total return in the last. Let's go with the last 5 years. So the last 5 years is only basically return about 22%, whereas S&P 500 has returned total return by that is including dividends and so on, 85%. And the last 10 years, 81% and 107. So it's underperformed the overall markets. Again, this is normal for this type of businesses, and you might say, okay, why do I want to own? Is actually underperforming the S&P 500. From a Sharia compliance side of things, I cannot invest in the entire S&P 500, because if I could, I'll just buy everything in VOO, then that's it, you let it be. But the fact is, there are companies out there that are almost closer to it and actually paying excellent dividends and so on, then I can potentially, I'm basically creating my own S&P 500, if you like. Okay, for that reason, because I have to pick up individual stocks, is probably a good would be a good investment in comparison to buying just of course the S&P 500, which we cannot buy. So yeah, there you have it. That's basically the company that I want to share with you guys today. And as always, please do your own research and find out more information about these companies, because sometimes, of course, you need to make sure that your goals and things that you want to do is completely different to what other people have. In my opinion, right now, I used to own the company. I sold it, and the reason I sold it is because there's low growth, and the fact that at the time I had too many consumer staples and I had to get rid of it. And since then, I haven't actually looked at it, and the reason I'm not going to look at it is because right now it's too expensive. If it comes down to maybe below $120 per share, then potentially I would look at it again. Anyway, please join us in the Patreon account if you haven't already. Have a wonderful day. Assalamu Alaikum.